If you're watching markets right now, stop scrolling for a second and listen, because something important is happening and most people are missing it. I'm talking to you if you care about where money is really flowing, not where headlines say it's flowing. While billions are getting wiped out in paper markets in a matter of hours, Beijing is doing something that should make you pay attention. They're doing nothing. No panic, no scramble, no emergency announcements. And here's the part that should make you lean in. China is still buying gold, still absorbing silver right now, even as prices whip around like a broken elevator. Stay with me, because I'm going to show you why that matters, how this mechanism actually works, and how you can spot it before it shows up on your feed. If you're watching this now, you're ahead of where most people will be in 2 weeks. Before I explain what caused this divergence, let me teach you something most people don't really understand about markets. Price and demand are not the same thing. They often move together, sure, but in stress events, they separate. And when they separate, that's when the real information shows up. Think of price like the weather app on your phone, and demand like what's actually happening outside your window. Sometimes your app says sunny, and you're getting soaked. When derivatives and futures dominate trading, prices can collapse even while real buyers quietly step in and accumulate. That's what you're watching now. Western markets are trading paper exposure, contracts, leverage, positions that exist on screens. China is focused on physical metal, bars, coins, reserves. 2 different games, same scoreboard. And if you don't understand which game is being played, you'll misread the signal every single time. So what does that tell us? It tells us that when you see price drop but hear nothing about fundamentals breaking, you need to ask what's actually moving. Is it real metal changing hands, or is it leveraged positions getting liquidated? Because those create opposite signals for the future. If this is making sense, drop a comment and let me know where you're watching from. I want to know who's paying attention to this. Now here's what's actually happening. Let me break down the sequence, because this isn't random and it's not chaos. First, global risk assets sell off hard. Stocks drop, bonds get weird, volatility spikes, margin calls hit. And when margin calls hit, leveraged funds dump whatever they can to raise cash fast. Gold and silver get sold not because their fundamentals broke, not because demand disappeared, but because they're liquid. You can sell them quickly and meet your margin requirement. That selling pressure hits futures markets first. It's fast, it's mechanical, and prices drop hard. Futures are where the leverage lives, so that's where the forced selling shows up. Now here's the confirmation layer. While futures are puking and Western traders are panicking, official data show the People's Bank of China added gold for 14 consecutive months through December. 14 months. That's not a trade, that's a policy. That's a strategic decision made at the highest levels. At the same time, inside China, physical silver demand stays elevated, not dropping, not pausing. And new export controls that kicked in January 1st tighten local supply even more. So when Western paper prices drop, Chinese physical prices don't follow the same script. You've got Shanghai premiums holding firm while New York futures crater. That divergence is the tell. That's your signal that 2 different markets are operating under 2 different motivations. And here's what's wild about this. You've got futures-driven selling meeting real-world accumulation at the exact same time. When that happens, inventories don't rebuild, they drain. You can see it in local premiums, you can see it in delivery times, and you can see it in how quietly the metal moves east without making headlines. Premiums in Shanghai stay elevated even as COMEX prices fall, delivery times extend, refineries stay busy. But here's the part that should make you nervous if you're only watching charts. These imbalances don't resolve sideways forever. They build tension, and when they snap toward the side with real demand, not the side with leverage. Let me show you what I mean. The futures market is a pricing mechanism, but it's also a casino. Most contracts never result in physical delivery. They're closed out, rolled over, settled in cash. So when a big wave of selling hits futures, it can move price dramatically without moving much actual metal. But physical buyers, especially central banks, they're not rolling contracts. They're taking delivery. They're moving metal into vaults. And when you have sustained physical demand meeting temporary paper selling, eventually the paper market has to reconcile with the physical reality. That reconciliation doesn't happen smoothly. It happens in bursts. Now let me show you what very few people are talking about. The export controls that China implemented on January 1st weren't just about silver. They included antimony, they included gallium, they included materials critical to technology and defense. But silver got swept into that policy umbrella because of its dual role as both industrial metal and monetary metal. What that means practically is that China is creating a bottleneck. They're the largest silver refiner in the world. If they restrict exports, even modestly, it tightens global supply. And if they're doing that while also accumulating quietly through state channels, you've got a 1-2 punch: reduced availability and increased official demand. That doesn't show up in price immediately because futures still dominate price discovery, but it shows up in premiums, delivery delays, and eventually it forces price to catch up. This is the exact same playbook that showed up in the early 2000s when Asian central banks started diversifying out of dollars. Back then, gold was under $400 an ounce. Western analysts said central bank gold buying was dead, that it was a relic, that nobody cared anymore. And quietly, China, Russia, and other nations started accumulating. By the time it showed up in official reports, years had passed, and the price had already started moving. Same pattern in 2008. Financial crisis hits, gold gets sold off initially in the panic, and then physical demand surged even as prices chopped violently. Every time this setup appeared, paper markets led the volatility, and physical markets set the floor. Zoom out, and you see the pattern repeat. Structural buyers don't chase candles. They don't panic buy at all-time highs. They accumulate during chaos when everyone else is confused. In 2011, silver spiked to nearly $50 and then crashed back to the 20s within weeks. Futures market went wild. Margin requirements changed mid-trade, chaos. But through that whole period, if you watched what central banks and sovereign buyers were doing, they didn't blink. They kept accumulating gold. They didn't chase silver at 50, but they didn't panic at 25 either. The larger story is this. When official institutions treat drawdowns as inventory opportunities, not warnings, they're telling you how they see the future monetary landscape. They're not trading, they're positioning for a decade from now. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be overinterpreted? Absolutely. China could pause their buying tomorrow. They've done it before. They go silent for months and then data shows up later. Silver demand could cool if global manufacturing slows harder than expected. If we hit a real recession, industrial demand drops, and that matters because silver is 60% industrial. And no, this doesn't mean prices go straight up tomorrow. Markets can stay irrational longer than you expect. I've watched setups that looked perfect sit dead for months. Here's the thing about manipulation narratives, though. You don't need them to understand this. You don't need to believe in shadowy cabals or secret suppression schemes. Focus on what you can verify. Official reserve data from the People's Bank of China, published monthly. Physical premiums in Shanghai versus London versus New York, tracked by multiple sources. Export rules, publicly announced and enforced. Behavior, not headlines. If you focus on verifiable behavior from non-emotional actors, you don't need to guess about motives. The actions tell you what you need to know. There are probably 3 types of people watching this right now. Maybe you're the trader. You're frustrated because price action feels disconnected and you want clean signals. You see silver drop 15% in a day and you don't know if that's opportunity or warning. For you, the lesson is timing and understanding market structure. When physical and futures diverge like this, volatility expands before direction resolves. That means wider swings, more whipsaw, harder to trade. Your edge is knowing that the volatility itself is the information. It's telling you the market is trying to reconcile 2 different realities. If you can tolerate the chop and focus on physical signals, not just price, you position better. But if you're over-leveraged or trying to catch every move, this environment will chew you up. Maybe you're the long-term stacker. You already believe in hard assets, and this just confirms your bias. You've been buying silver for years, and you're not shaken by a quick drop. For you, the takeaway is patience and discipline, not excitement. It's easy to feel vindicated when you see divergence like this, but don't let that turn into complacency. Keep your position sizing rational. Don't overextend because you think you spotted the bottom. The fundamentals support your thesis, but timing is still uncertain. Your advantage is that you're not forced to act. You can wait. You can accumulate slowly, and you can ignore the noise because you're playing a different game than the traders. Or maybe you're new and just trying to understand why everyone's yelling online. You see silver crash and gold drop and headlines screaming about risk off, and you don't know what to believe. For you, the key is learning how different market layers interact so you're not shaken out by noise that doesn't matter. Understand that futures markets, physical markets, and retail markets all move differently. What you see on a chart might not reflect what's happening in vaults or refineries. Build your knowledge slowly. Don't rush into positions because you fear missing out. The opportunity isn't going away overnight. The universal principle for all of you is the same, though. Watch what big, non-emotional buyers do during stress. Not what they say, what they do. That's where the real information lives. So here's what I want you to answer in the comments. Are you watching price or are you watching behavior? Because I think that's the distinction that separates people who get shaken out from people who position well. Let me know what you think. So here's where I stand. I'm not panicking, and I'm not pounding the table telling you this is the bottom or the top. I'm observing. I'm watching the data, and I'm keeping my emotions in check. Let me tell you what I'm personally watching. First, I'm watching official gold reserve updates out of Beijing. If they pause or slow down, that would indicate either a policy shift or that they've hit a target threshold. If they keep going, it confirms this is long-term strategic. Second, I'm watching physical silver premiums inside China versus Western futures. If that spread widens, it means the divergence is intensifying and something has to give. If it narrows, it means the markets are reconciling. Third, I'm monitoring inventory flows at major depositories and export policy signals. If we see drawdowns at COMEX or LBMA without corresponding price increases, that's another confirmation that physical is tightening regardless of paper price. Based on my analysis, this recent crash wasn't emotional. It was mechanical. It was driven by leverage and margin, not by a fundamental breakdown in the case for precious metals. The fundamental picture hasn't changed. You've still got record debt levels globally. You've still got central banks buying gold at the fastest pace in decades. You've still got supply constraints in silver because nobody's investing in new mines. You've still got industrial demand growing for solar, EVs, and electronics. None of that broke in the last 72 hours. If history rhymes and physical accumulation continues while paper markets chop, the move that follows could be significant. I'm not giving you a price target because I don't trade that way, and neither should you. But I will say this. Every major move in precious metals over the last 2 decades started with a setup that looked a lot like this: confusion, volatility, divergence between paper and physical, and then resolution toward the side with real demand. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Don't take my word for it or anyone else's. But if you made it this far, you're someone who thinks critically and doesn't just react to headlines. That mentality will serve you well, no matter what happens next. If this breakdown helped you see the bigger picture, share it with someone who needs to hear it. Subscribe if you want more analysis like this. And stay ahead of the noise, because that's where the edge is. Stay sharp out there. Think critically. Verify the data. And make your own decisions.